Welcome to today's explainer. Look, if you've been watching the markets lately, you've probably seen the absolute carnage in the enterprise software sector. The narrative out there is frankly terrifying. Artificial intelligence is going to wipe out traditional software, literally seat by seat. And right at the center of this storm, ServiceNow, ticker symbol NOW. Today, we're going to apply that modern investor essence to cut right through the panic. We're unpacking this massive enterprise software mystery, looking at the hard data, and figuring out if this is truly the end of an era or the birth of the next giant? Okay, let's dive into this.
Now, here is the sheer paradox of the whole situation. In the fourth quarter of 2025, ServiceNow completely crushed it. Earnings per share came in at 92 cents, easily beating estimates, and revenue hit a massive $3.57 billion. Yet in after-hours trading, the stock suffered a brutal 11.43% drop. Think about that. The company delivers a flawless quarter and Wall Street punishes them with a double-digit sell-off. Why? What exactly is the market seeing that the earnings report isn't showing us?
To answer that, let's build up your financial literacy step by step. Here's our roadmap for today. Number 1, the Great SaaS Panic. Number 2, not a traditional software company. Number 3, financial margins and ratios. Number 4, future growth and backlog orders. And finally, number 5, what is in there for investors.
All right, starting with Section 1, the Great SaaS Panic, market fear and macro headwinds. So UBS recently downgraded ServiceNow from buy to neutral, slashing their price target down to $100. This right here is the heart of what analysts are calling the SaaSopocalypse. You see, the market is completely terrified of something called seat compression. The theory goes like this. As autonomous AI agents get smarter, they're going to start doing human jobs. Fewer human workers means fewer software licenses. And that narrative, it's currently driving this massive sell-off.
But honestly, it's not just AI fears. We objectively have to factor in the heavy macro pressures hitting the market right now. We're seeing historic 125% US-China tariffs, and that's triggered a huge risk-off sell-off across the entire tech sector. On top of that, we have federal spending cuts being driven by the Department of Government Efficiency, or DOGE, which directly impacts software vendors who rely heavily on government contracts. Combine these external pressures and, well, you get a brutal repricing of high-multiple software stocks.
Moving on to Section 2, not a traditional software company, the core business engine. The absolutely crucial point here is redefining what ServiceNow actually does. They are no more a traditional software company. Actually, CEO Bill McDermott calls them the AI control tower for the enterprise. Think about it. If a massive company deploys thousands of autonomous AI agents across a bunch of different departments, those agents still need a central nervous system. They need something to securely govern their actions, manage their data, and orchestrate their workflows. ServiceNow isn't the software being replaced by AI. It's the platform that the AI actually runs on.
Let's look closer at the company's business model and growth engine. They've expanded way beyond basic IT. They orchestrate employee workflows for HR, they handle customer workflows for service and field ops, they manage security operations, and even allow companies to build their own custom apps. And the kicker? They do all of this on one unified data model. This means an AI agent can smoothly resolve a really complex task, like offboarding an employee, across HR, IT, and finance without any human intervention at all. Because of this, their total addressable market has literally exploded to over $275 billion.
Let's move to Section 3, financial numbers and profit growth, with margin, important financial ratio, the hard numbers of growth.
Let's trace these numbers. From $2.95 billion in Q4 of 2024, their top-line revenue jumped to $3.57 billion in Q4 of 2025. That is consistent, massive growth. But what's truly staggering is their 2026 guidance. They're projecting subscription revenues between $15.53 and $15.57 billion. We're talking about a 19.5 to 20% growth rate at a massive scale. So while the broader market is full on panicking about AI replacing software, ServiceNow's actual revenue is accelerating.
In the software world, smart investors always look for the rule of 40, where your growth rate plus your profit margin equals 40 or more. Well, ServiceNow is operating at a pristine Rule of 55+ profile. In Q4 alone, they generated an incredible 57% free cash flow margin. Generating 20% top-line growth while throwing off that much cash, that puts ServiceNow in a financial category of 1. There's almost nobody else doing this.
98%. Just take a second to absorb that number. That is ServiceNow's consistent customer renewal rate. Now, why does literally nobody leave? Because once a Fortune 500 company integrates ServiceNow across their IT, HR, and security departments, it literally becomes their operational nervous system. It is incredibly sticky. You don't just rip out your central nervous system because a cool new AI chatbot comes along, right?
Okay, Section 4, Recent Investment, Future Growth, and Backlog Orders, the Agentic Enterprise.
They are aggressively building an impenetrable wall right now. Let's look at the recent investments to secure this dominance. In May 2025, they bought Logic.io. In December, they closed a massive $2.4 billion deal for Moveworks, bringing in top-tier AI search and agent tech. Now, looking ahead into 2026, they are acquiring Veza for identity security and dropping an astounding $7.75 billion on Armis for asset security. They are strategically buying the exact pieces needed to ensure they are the safest, most robust AI platform on Earth.
And the proof that this strategy is working is staggering. $28.2 billion. That is ServiceNow's remaining performance obligations, or RPO, as of Q4 2025. Basically, that's revenue that is already contracted and effectively preloaded. They are walking into the future with massive, guaranteed financial visibility.
Finally, Section 5. What is in there for investor? Patience over hype. Let's break down some important financial ratios to understand exactly what is in there for investors right now. Because of this massive sell-off, the stock's valuation has compressed significantly. The price-to-earnings ratio is sitting near a 1-year low. The price-to-sales ratio is near a 5-year low. And the price-to-book ratio is brushing up against a 10-year low. When you find a company growing revenue at 20%, with 57% free cash flow margins trading at historic valuation lows, well, focused learners definitely take notice.
And guess what? Management knows exactly what a steal their own stock is right now. CEO Bill McDermott bluntly stated, "We are playing offense on our tippy toes." And to back up those words, the board just authorized an additional $5 billion share repurchase program, planning an imminent $2 billion accelerated buyback. Look, when a company with $10 billion in cash uses the market's panic to buy its own stock at a huge discount, that is the ultimate vote of confidence.
So we arrive at our final question. The market is priced in an apocalypse, yet the financials clearly show a fundamentally flawless engine running the modern enterprise. Is this the moment to practice patience over hype and time the right entry? Are we looking at what could very well be the market's next boomer stock? If you can separate the fear-driven narrative from the hard numbers, you can turn your AI confusion into AI confidence and invest when time is right. Thanks for joining me on today's Explainer, and I'll catch you on the next Deep Dive.